Let me start with the question that's probably eating at every gold and silver investor right now. You bought gold. You watched the geopolitical chaos unfold. You followed the playbook you were taught. You did what you were supposed to do. And your position is red. Gold down 13%, down 14%. Silver down more than 46% from its January high. Meanwhile, bombs are still falling in the Middle East. Central banks are still buying gold at roughly double the historical average. The national debt has pushed beyond $39 trillion. So I want to ask you directly, do you understand why this is happening? Not the surface explanation, the real mechanism. Because if you don't understand it, you're going to make the wrong decision at the wrong moment. And that single decision can cost you what may be the most important precious metals move of the next 5 years. I've been studying how gold and silver behave during geopolitical crises and oil shocks for decades. And what I'm going to show you is not a feeling or a social media narrative. It's a mechanical sequence that has repeated after every major oil shock since 1973 with remarkable consistency. And once you see it clearly, you cannot unsee it. By the end of this, you'll understand the exact sequence that can push gold down during a war, the historical record of what gold and silver tend to do after that initial drop over the last 50 years, the four-phase pattern that tends to follow major oil shocks, and why the structural setup in 2026 is more extreme than any previous cycle, which is why the next move could be larger than most people can mentally accept right now. Now let's start with the mechanism, because until you understand this, nothing else you're watching makes sense. Here's the question most financial media avoids answering cleanly. Why does gold sometimes fall during a war? It sounds backwards. Gold is supposed to be the safe haven, the bomb shelter asset, the thing you buy when the world is on fire. So why, when the Strait of Hormuz becomes a crisis point and the region escalates, does gold drop hard, say from a peak near $5,419 down toward the $4,600? The answer is not gold failed. The answer is a sequence. Write this down, because once you understand it, you'll recognize it every time it appears, and you won't get blindsided by it again. Step 1. A geopolitical event triggers an oil shock. In this environment, conflict risk around key supply routes can drive Brent crude from the 70s into the $110 plus range rapidly. That is not a normal move. That is the kind of energy disruption that changes macro assumptions in days, not months. Step 2. The oil spike pushes inflation expectations higher. Not necessarily realized CPI overnight expectations, and markets price expectations immediately. Inflation expectations matter because they shape what traders believe the central bank can and cannot do next. Step 3. Higher inflation expectations block the Fed from cutting. Before an oil shock, markets can price rate cuts. After an oil shock, the Fed's flexibility collapses because cutting into a fresh inflation impulse is politically and financially dangerous. The futures market begins removing near-term cuts from the curve. Step 4. If the Fed can't cut, yields stay elevated or rise. And this is where the key number becomes a weapon. The 10-year Treasury yield, call it 4.39% in this scenario, becomes a competing safe asset. A U.S. government bond paying over 4% feels like safety with income. Step 5. When yields are high, the opportunity cost of holding gold rises. Gold pays nothing. No coupon, no dividend. So institutional capital does the math, and some portion rotates from zero-yield metals into yielding treasuries. Step 6. Global safety flows strengthen the dollar. When global investors buy U.S. treasuries, they buy dollars. That demand lifts the dollar index. And because gold is priced in dollars, a stronger dollar mechanically pressures the dollar price of gold. If each dollar buys more, it takes fewer dollars to buy an ounce, at least temporarily. That's the key. One oil shock creates 3 simultaneous headwinds for gold: higher yields, stronger dollar, and rotation into income assets, exactly while the world is screaming, safe haven. That's why your gold can be red while the world burns. And here's the part that matters. That suppression is real, but it is not permanent. I have watched it resolve the same way again and again. And if you understand how it resolves, you stop making emotional decisions inside phase 2 of the cycle. Now I want to show you the historical record, not as a guarantee, not as a promise, but as evidence that this sequence is not random. 1973, the oil embargo era. Oil prices shock the system. Gold does not behave like a perfect straight-line safe haven on day one. But after the system digests the shock and policy responses unfold, Gold rises dramatically over the following years. Zoom out over the full 1970s arc and the move becomes historic. 1979, the Iranian Revolution era. Oil spikes again. Gold doesn't instantly do what the average investor expects in a neat line. Then it moves hard, first in the months that follow, and then into a peak that became one of the defining gold moments in modern market history. 1990 to 1991, Gulf War shock. Oil jumps fast. Gold pops. Defense and energy-related themes outperform. The market then transitions into a new regime as policy and growth expectations shift. Post 9/11, a different type of shock, but still a structural pivot. Markets panic, confidence breaks, and gold begins a multi-year trend that ends far higher than almost anyone expected in the moment. 2022, Russia-Ukraine and the sanctions era. Gold pushes into new highs as reserve asset neutrality is questioned, and central banks accelerate purchases. Again, not because of internet hype, but because institutions reposition. The consistent point isn't that gold never dips. The consistent point is that the mechanism that suppresses gold during the initial shock phase eventually flips. And when it flips, gold responds not to fear headlines, but to macro reality: currency credibility, rate direction, debt math, and policy constraints. Now here's what makes 2026 structurally different from prior cycles. And this is the part that should change how you think. The war is not the unique variable. The base layer the war landed on is the unique variable. In 1973, U.S. national debt was around $500 billion. Today, it's beyond $39 trillion. That's not the same story, but bigger. That is a completely different fiscal structure. In 1973, central banks were not accumulating gold at anything like today's pace. Today, central banks are still buying at elevated levels compared with pre-2022 norms, after multiple years of record purchases. That's not a fashion trend. That's strategic repositioning. In earlier cycles, silver did not have the same persistent supply deficit dynamics we see now. Today, the silver market has been running deficits for years, demand exceeding supply and inventories being drawn down, while supply remains inelastic because silver is largely mined as a byproduct of other metals. You don't just turn on silver production because silver price rises. In earlier cycles, industrial demand for silver was smaller. Today, silver is embedded in critical systems: solar, EVs, high-end electronics, defense hardware, and the expanding AI data center build-out. Many of these applications are not easily substitutable without performance loss. And perhaps most importantly, in the 1970s, the Fed could eventually crush inflation with extremely high rates. In today's structure, the interest expense on enormous debt limits how far rates can be pushed before the fiscal system itself becomes the crisis. So when an oil shock arrives on top of massive debt, ongoing central bank gold accumulation, persistent silver deficits, and a Fed constrained by fiscal arithmetic, the back half of the cycle can be more powerful than earlier analogs. That is why I'm using the word unthinkable, not because it's magic, because the structural conditions are more extreme. Now let's talk about what comes next in a way you can actually use. The four-phase pattern that tends to follow major oil shocks. Phase 1, the panic phase. This is usually the first 1 to 4 weeks. Oil spikes. Gold often spikes with it, then drops as the mechanism kicks in. Higher yields, stronger dollar, forced selling, and rotation into treasuries. Financial media goes into 24-hour crisis mode with red graphics designed to trigger your nervous system. Retail investors usually do one of two things: panic sell at the bottom of the first drop, or panic buy at the top of the first spike. Both are commonly poor timing decisions. Institutions in phase 1? Usually they watch. They've seen the sequence. They don't need to act dramatically. They start planning. Phase 2, the absorption phase. Typically month 2 to 3. The initial terror eases slightly. Volatility cools a bit. Gold and silver can stay depressed or drift lower. Silver often gets hit harder because it is more volatile and more sensitive to liquidity selling. This is where the most expensive mistake happens. People see red. They read "gold failed" headlines. They conclude the thesis is broken and they sell into the low confidence window. Phase 2 is often where weak hands exit. And historically, that's why Phase 2 frequently ends up being near the lows, not because pain disappears, but because selling exhausts. Phase 3, the structural bid phase. Typically month 4 through 18. This is where forced liquidation fades and structural buyers take over. Central banks accumulate regardless of short-term price action. Long-term allocators begin rebalancing. Physical demand strengthens, and the macro drivers that were always there, debt, currency debasement risk, policy shifts, begin to dominate again. Gold finds a bid that is not a panic bid, but a structural one. Silver starts to stabilize, and then, when the monetary bid returns, it can move with much higher velocity. Miners begin to respond as profitability improves with stabilized metals prices. Energy infrastructure continues to benefit from route restructuring and investment in redundancy. This is also where retail often sits on the sidelines saying, "I'll wait for the pullback." And sometimes that pullback never comes in the clean, comfortable way they want. Phase 4, new all-time highs. Typically 12 months onward, sometimes extending into multi-year runs. The sequence is usually the same. Oil shock embeds inflation pressures, the Fed remains constrained, recession risk eventually forces easing, yields fall, the dollar weakens, and the three headwinds reverse. When they reverse together, gold and silver can move violently upward. Now, where are we today? Based on the timeline and price behavior you described, gold down from the peak, silver heavily off highs, yields elevated, dollar supported, I would describe the market as somewhere in the transition between phase 2 and phase 3. The panic selling has happened. Forced liquidation from margin calls is fading. Structural buyers, central banks, long-term allocators, and physical markets are increasingly the marginal bid at these levels. Some forecasters have adjusted near-term targets while keeping longer-term projections extremely high, essentially framing gold not as a one-year trade, but as a debt cycle outcome. That distinction matters. A debt cycle thesis survives drawdowns better than a short-term narrative. Now I want to address silver specifically because silver's story in this cycle is not identical to gold's, and misunderstanding that can make you either overconfident or overly pessimistic at the wrong time. Silver has a dual identity. It's monetary and industrial. Gold's initial move in many cycles is driven largely by monetary and sovereign behavior. Silver often lags early, then accelerates later, sometimes dramatically, because when the monetary bid returns, it stacks on top of industrial demand that never stopped. In the late 1970s cycle, silver didn't just follow gold, it outperformed explosively. Gold rose strongly into its peak. Silver went from roughly $5 to $50, a tenfold move. The magnitude was different because silver's small market size and dual demand structure can create violent repricing when investment demand meets tight supply. In 2026, the industrial engine is stronger than in prior cycles. Solar installations consume silver. EVs require more silver than conventional vehicles. High-end electronics, defense systems, satellites, and data center infrastructure rely on silver's conductive properties. Many of these applications cannot simply swap silver out without performance trade-offs. Then there's supply. If you're running consecutive years of deficit, inventories draw down. And because silver is mostly a byproduct, the supply response is slow. That is exactly the setup where silver can lag, frustrate, and then suddenly outperform when the monetary bid returns. Now let's close with the two indicators that matter most for confirming the shift from phase 2 into phase 3, the moment when mechanical suppression is truly fading. Indicator 1, the US dollar index. If the dollar has been elevated due to emergency demand and safety flows, gold can be suppressed. When the dollar begins to weaken, say DXY moving meaningfully lower, for example below the high 90s levels, one of gold's biggest mechanical headwinds eases. This tends to happen when oil stabilizes, supply routes adapt, and the emergency scramble for dollars eases. Indicator 2, the 10-year Treasury yield. As long as yields are high, think 4% plus, the opportunity cost argument against gold remains strong for institutions. When yields fall meaningfully, down toward the mid-threes in this framework, the math begins shifting back in favor of gold and other non-yielding hedges. That tends to happen when recession risk dominates and the Fed pivots toward easing. And this is the key point. The war headlines won't tell you when the reversal is real. Daily oil drama won't tell you. Television coverage won't tell you. The dollar and the yield will tell you. Now consider the targets being put out by large institutional research shops, numbers in the low 6,000s by late 2026 from multiple sources. Whether those targets hit exactly is not the point. The point is that the institutions making those projections are not assuming the current suppression is permanent. They are explicitly assuming it is temporary, and they are using the same drivers we just discussed: central bank buying, debt dynamics, rate trajectory, and silver's structural deficit. So here's the fork in the road. There are two types of investors in moments like this: The first sees gold down from the highs and concludes the trade is dead. They sell in phase two. Later, when prices recover, they say, "I knew I should have held." The second sees the same drawdown and recognizes the pattern. Absorption phase, mechanical suppression, structural setup stronger than it was at the top. They accumulate quietly while the noise is loudest, because they understand what always comes next when the cycle turns. The unthinkable is not unthinkable because it has never happened. It has happened after every major oil shock over the last 50 years. It feels unthinkable because the base conditions, debt, central bank behavior, silver deficits, industrial dependence, and fiscal constraints on the Fed, are more extreme than most investors have ever experienced in one stacked environment. Watch the dollar, watch the yield, be patient, and don't let a phase two sell-off convince you to abandon the very move that the structural math is setting up.